A very good evening to each one of you. On behalf of Bangalore Chamber of Industry and Commerce, we welcome you all for this session on cryptocurrency as investment and relevance of blockchain beyond crypto. This session is organized under the aegis of Banking, Finance and Corporate Affairs Expert Committee. On behalf of the Chamber, we express our sincere thanks to Mr. Swapnil Pawar, who is the blockchain entrepreneur, Mr. Jay Prakash Pai, founder and director, Wealth Managers United India, for accepting our invitation to address at this exclusive session. The Chamber also would like to place on record our sincere thanks to Dr. Ravindran, who is the Senior Vice President of the Chamber, for facilitating the speakers for this session. We express our sincere thanks to the leaders of the expert committee, chaired by Dr. K.V. Om Prakash, who is also the founder director, Consentia Consultancy, co-chaired by Mr. Joydeep Nag, head of Tech Enabling Center, Amrita Vishwa Vidyapeetham, and mentored by Mr. N. Venkat Krishnan, Executive Vice President and CFO, Tata Hitachi Construction Machinery, for structuring this session. Thank you very much, sir. And we express our thanks to all the participants for supporting us by joining to this session. I now hand over the platform to Dr. Om Prakash. Over to you, sir.
Thank you, Rupa, and I cordially welcome all the attendees, participants to this webinar on cryptocurrency as investment and relevance of blockchain beyond crypto. Today, this word has been a magic. I would recognize presence of the Senior Vice President, Dr. L. Ravindran, the BCIC team, and all the members and all the participants who have attended, taken their time off. Welcome you all to this wonderful session, and I welcome the speaker for the day, Mr. Swapnil Pawar, blockchain entrepreneur, and Mr. Jay Prakash Pai, the moderator and the founder of Wealth Managers United India Private Limited. So they are the sponsors. I thank them very much. And I also thank Dr. L. Ravindran for introducing his alumni, Dr. Swapnil. And to begin with, people are confused or have inhibitions as to what is cryptocurrency, what does it mean, is it a right choice for investment, is it something like shares, or is it beyond gold, is it a shortcut method for making money, is there any regulatory body in India to govern it? So these are the main topics which will be covered in this webinar, and the speakers are available for any questions. We have also compiled few questions so that the moderator of the day, Mr. Jay Prakash, will be moderating the whole webinar, and he will be shooting questions on behalf of BCIC. And before handing over the platform to Mr. Jay, I would introduce him. Jay has done his CS, LLB. He's a commerce graduate with about 25 years of experience in the financial service industry. He was heading HSBC prior to this avatar, and he was the private banking for Southern India for about 5 years in HSBC. And prior to that, he was with Deutsche Bank Private Wealth Managers for about 7 years. And he started in Canfin's Homes Limited in the financial side. And this is all about Mr. Jay. And on his personal front, he is an Iron Man. He is a marathoner, ultra marathoner. He runs. Swapnil, be careful. He might run to your place. So he's a trekker as well. His hobbies are trekking, traveling, and golfing. In the year 2019, he completed his Ironman, where it was a triathlon with swimming, running, and cycling. It has boggling numbers, and he has completed that. On to you, Mr. Jay. Welcome to you.
Thank you. Thank you, Om. Can you hear me?
Yes, we can.
We can hear you, but we can't see you, Jay.
I'm really sorry. There is some
It's okay. It's okay. It's okay.
with my camera, so you have to excuse me today. So first of all, let me welcome Swapnil. Thank you for being with us today. So good evening, listeners. I just want to introduce you to Swapnil Pawar to you, and we have a person with us to talk about crypto, a person who invests in crypto, who writes about crypto. He has written a lot about crypto. If you see the social media, there are a lot of articles written by Swapnil, and he's also engaged in a business into blockchain technology. So Swapnil is a graduate from IIT Bombay and postgraduate from IIM Ahmedabad, and he's a fintech professional with over 17 years of experience in the intersection of technology and financial services. He's the founder of ASQI, which he is spearheaded setting up new RL. Is it right? How do we pronounce it?
Neural.
Neural.
Like similar to the brain. Yeah.
Yeah, you are saying something.
No, just I'm saying neural as in neural network. That's sort of neural.
Neural. Okay. A public blockchain aimed at mainstream financial services. Swapnil has a wide experience across blockchain and quantitative strategies and multi-asset portfolio management, credit, and alternative assets. So he has worked with the Boston Consulting Group, advising clients across engineering, technology, and banking sectors. Swapnil has been recognized as one of the 40 under 40 professionals in alternative investment space in India. That's a great to hear, Swapnil. And Swapnil also has authored a book titled Anatomy of Froth, Demystifying the Global Financial Crisis. Besides, he has written several papers and articles across media. Today, it's our really a pleasure to have Swapnil and a person who is really enlightened as far as the blockchain and crypto is concerned. So recently, Nobel Prize nominee mentioned that every person need to know about crypto because it might be one of the world's most important developments after internet, right? So the whole objective today is to gather knowledge and pick your brains, and most of the members here will definitely benefit from what we are hearing from you. And we have been hearing a lot about crypto and blockchain, and that's going to change the world, right? There are about 100 million crypto users. Out of that, 15 million users are in India, which is there's a cult, I think, following crypto in India. And now I request all the listeners to write your questions in the chat box. When after initial presentation by Swapnil will give us an opportunity to ask all questions, and he will definitely address as many questions as possible. We are all waiting to hear from you, Swapnil, all about crypto and how crypto is going to change the world. And I'm sure we're all going to benefit out of it. Over to you, Swapnil.
Thanks. Thanks, guys, so much for the kind introduction. And thanks, Dr. Om Prakash, for inviting me, and Dr. Ravindran. And thank you all the listeners for joining this session. Before we actually go into what is crypto and investment, I thought I'll just lay out the thought process behind this session. There are two types of people who want to know about what's going on with the crypto media hype, if you will. One is investors who are keen to evaluate it as an investment opportunity or the lack thereof. And second is business persons who are keen to understand the broader implications of the underlying blockchain technology for the economy, the business, and what implications it has for their business in particular, directly or indirectly. So that's why the title of the session is also split as cryptocurrency as investment and the blockchain technology beyond crypto. And I'd love to answer questions on both. In the walkthrough today, I'll walk through a couple of slides on crypto, a couple of slides on non-crypto, and reserve the rest of the slides for answering specific questions. Otherwise, it becomes too long a monologue. So let me just get started with the first part, which is cryptocurrency itself. I'll just look at the first of this agenda and look at the other agenda items only in response to specific questions, because otherwise it just repeats. So let's look at the high-level overview of what a blockchain is. And this specifically talks about public blockchains, such as Bitcoin, Ethereum, and many others that you might have heard of. Now, the way it differs from a conventional centralized system like a bank is in the fact that there is no privileged keeper of information or records. So to contrast it with the conventional system, think of the simplest use case, X paying Y. And in fact, Bitcoin, which is what started in 2009, the whole blockchain revolution, and cryptocurrencies, which were subsequently built in a similar manner, Bitcoin is at the heart of it simply a payment mechanism. It doesn't do anything else. Ethereum is far more versatile and other chains do more stuff, but Bitcoin is a very simple payment system. If I want to pay someone, I can pay rupees, dollars, or Bitcoin. It's really, originally it was meant only as that, not an investment asset. And the crucial difference between a Bitcoin and a dollar payment is that the dollar payment is routed, I'm ignoring cash here, I'm just saying dollar payment through a bank would essentially be I telling my bank through either a check or an internet-based request to pay someone else a certain amount of dollars. The bank then checks if I have the balance to make that payment. If I do have it, then it confirms that I am the one who's asked for this request, basically through my login password and any other thing. And then it credits the account of the other party. And other party can check that it is credited. So this is what is called a centralized system, because bank is the only entity which can make this change happen. In a Bitcoin network, I'm using Bitcoin in a generic sense for all cryptocurrencies. In a cryptocurrency network, a transaction is requested. So this is the part we're talking about here. This transaction is not sent to a central party like a bank. It is actually broadcasted to the entire network. And this is a signed transaction, so to speak. So when instead of me logging into my internet banking and saying transfer the $100, I transmit a transaction paying Y, half a cryptocurrency or 1 unit of a cryptocurrency, as a signed, cryptographically signed transaction. And I hope that it gets confirmed. Now, what is the transaction lifecycle after that? All the other nodes on the network receive this transaction. They check that this is a valid transaction because my signature is there. It's cryptographically verifiable. We'll look at that and answer to specific questions, but that's what other nodes do. And once every so often, so every 10 minutes on the bigger chains like Ethereum and all, every 10 minutes, the transactions are clubbed together into what is called a block. And these are all valid transactions anyway because everybody has checked them. And the block creator also checks them one more time. And this block is then added to the chain. The reason it's a chain is because each block, this is the structure of a typical block. Each block has a fingerprint of the previous block, which is what is called hash in a technical sense, and its own set of transactions. And since every block has the fingerprint of the previous block, you can't tamper with one block in isolation. So that's the whole idea of calling it a chain of blocks. So instead of listing, say, if there are 10,000 transactions in a year, they can just be listed in one ledger, like a bank would do it. So X paying Y, P paying Q, A paying B, and so on and so forth. Essentially, maintain it as a sequence of blocks with each of them cryptographically quote unquote locked. So you can't open them to tamper it because that will change the hash and then so on and so forth. So the idea here is that if it is a private ledger, like a bank has it, then the bank can change it maliciously or legitimately. But I can't change it, you can't change it, the recipients can't change it. So in a public ledger, there is no bank. So then how do you decide who gets to change it? That's the mechanism of creating these cryptographic hashes and locking transactions in a block, and everybody validates. That's the crucial point. Nobody is privileged to say that this is a valid transaction or not. And majority rules. So if 99% say a transaction is valid, it is valid. Assumption here is that they are not colluding and they're all basically looking after their own interests. So that's in a nutshell what a blockchain is. Cryptocurrency in particular is a subset of the blockchain technology deployment, and it is broadly speaking a digital store of value. It is native to that specific chain on which it is issued. So Ether is native to Ethereum. Native, you can think of native as rupee is native to India, dollar is native to US, and the ruble is native to Russia. In that sense, Bitcoin is native to Bitcoin network, Ether is native to Ethereum network, and so on and so forth. And the idea is that they are scarce and hence valuable, similar to gold, created through mining and meant to be for peer-to-peer payments, but has now become more of an investment asset in the form of a digital gold. So let me pause here and move on to the questions and answers, because then that probably is a better way to handle the rest of the concepts. So Jay, over to you again, if we can go through the key questions.
Yeah, sure. So let us start. There are a lot of questions, right? So let me start with one important question. Why the governments do not like cryptocurrency? Because they think that they're losing control or something. Why cryptocurrency is not liked by government across?
Right. So there is a legitimate reason that the governments fear cryptocurrency, and it's a logical reason. It's not the typical bureaucratic fear of anything new. Cryptocurrency and blockchain that way have gotten unnecessarily conflated, but let me just look at cryptocurrency in isolation. So blockchain as a technology is simply a technology. It can be used for anything else. Like you would say, for example, nuclear fission is a technology. Now you can use it to create a bomb, you can use it to create nuclear energy or power spacecraft, whatever. Likewise, blockchain as a technology, you can use it for creating a currency. You can use it for creating tokens for real estate. You can use it for payments across geographies. The specific use case that the governments are very against is the currency use case, which is what Bitcoin originally started out as. So the genesis of Bitcoin was in the global financial crisis and people's aversion to the quantitative easing that came after it. A lot of people, experts and otherwise, believe that the quantitative easing created by Fed, this is not 2020 I'm talking about, it's 2009, would lead to hyperinflation. It didn't materialize finally, but there was a lot of talk and fear of debasing of dollar and other currencies, euro, yen, everything else. So fear was that the government is printing so much money, the money that we have in our bank accounts and fixed deposits will lose value. So a set of people who were politically inclined towards libertarianism and stricter monetary policy, if you will. So that doesn't include me. I'm a big Keynesian at heart, and I don't agree with the Bitcoin core philosophy of currency, but let's conclude their argument as to what it started with and why governments are afraid of it. So Bitcoin creators thought that they could create a parallel currency with which they could pay each other. And that currency is not printed by Federal Reserve or any other ECB or any other central bank. So its supply is kept finite. 2140 is when 21 million Bitcoins will be mined and it will stop. So everyone knows that. It's algorithmically precise. So since the supply is finite, its value cannot be debased by virtue of some government fiat. So that was the original thesis, and this thinking has made governments wary of cryptocurrency, because cryptocurrency exponents by definition then tend to be very wary of any government control or government intervention, and governments are rightly wary of cryptocurrencies trying to compete with conventional currencies, by which then they will lose control if the dream of Bitcoin enthusiasts comes about, that people start to pay each other in Bitcoin and Ethers and other things. Then there is nothing left for monetary policy to do or fiscal policy to do. And that obviously is a major issue for any government in any modern economy. So that's the fear. Seems unrealistic. Conceptually, it's correct. Realistically, it's never going to happen, because the payment use case of Bitcoin is anyway fallen by the wayside. Nobody uses Bitcoin to pay anything. But yes, the whole aversion to fiat currency embedded in the original cryptocurrencies is potentially a source of concern for government.
Is it possible that across the world, governments all together come together and say, let's prohibit crypto? Is it possible? Because in such a scenario, it can lose its value, right? Is it possible it can happen?
If the cryptocurrency world remained only about Bitcoin and Bitcoin alone, then there was a fairly good chance that at some point the government would have simply made it illegal for the fear of it becoming too big and competing with their own currency. For better or worse, that didn't happen. And other than a few big enthusiasts, nobody really uses Bitcoin to buy anything or sell anything. Instead, it became digital gold, which is a investment asset class. So there, the Western governments in particular are pretty liberal about it, because it's a case of buyer beware. There are hedge funds, there are wine funds, there are art funds. So why shouldn't there be some digital asset like Bitcoin, which people choose to buy or not based on their personal preferences, so long as they don't use it as a legal tender to settle payments. And its market capitalization is just $1 trillion. It's nowhere near what the balance sheet of Fed is or the money supply in the world is. So in parallel, what happened was after 2015, Ethereum came about. Ethereum is a very interesting experiment which goes way beyond payments. I won't go into the technicality of it, but suffices to say that Ethereum enables what are called smart contracts, which are essentially algorithms to execute business logic. So if I were to simply think of a business logic like, I borrow from someone with the security of something. If I don't pay, the lender should have the ability to seize the security and sell it and settle the loan. This simple transaction in the modern world has become very complicated because of all sorts of malicious behavior by borrowers, complications in tracking ownership assets, taking legal control of the asset to sell it, and so on and so forth. Now, if we were to make a smart contract which automatically, without a third party monitoring it, would sell the collateral in the event of a default and settle the loan, giving the lender what was owed to her, then we have essentially achieved contract enforcement algorithmically inside a blockchain. That's the aspiration of Ethereum and many other blockchains based on that technology. Now, this opens up the blockchain technology to use cases beyond payment. And frankly, Ethereum itself doesn't think of itself as a payment system. It thinks of itself more as a smart contract repository. And its aim is to be used in business logic, and so does our company, Neural. Our aim is also the same. So these use cases mean that the governments around the world aren't going to be afraid of genuine technological innovation, which allows better contract enforcement, higher financial inclusion, innovation in payments to reduce friction. For example, the cost of remittance can be brought down from 5% to 0.5% or less if you use blockchain technology. The cost of microloan enforcement can be brought down from, say, $50 to $1.50. capital market transactions can be settled in real time or same day. You can fractionalize bonds so that you can be bought and sold at $1. You can fractionalize properties. You can buy and sell them at $1. So such innovations will come out of blockchain technology. And so it's unlikely that governments would all unite and say all cryptocurrencies are banned from here onwards.
Okay. So now Government of India is talking about bringing some regulation. So can you throw some light on what is the regulation outside India, if any of the other governments have actually brought in, and what is the regulation expected in India?
So regulation outside India, it varies by country. The most progressive or blockchain friendly regulations are probably in Singapore, UK, UAE, Germany, Portugal, and US, and Canada and Australia. So to give a very concrete example, in US now, SEC allows you to issue a cryptocurrency under the securities token offering. So it's like just like stock offering. So what we call share of an unlisted company. In the STO regulations make even cryptocurrencies issued by a company similar to securities of that sort. It's properly regulated under 3/4 specific rules. UK government is also similarly allowing crypto assets to be issued. Singapore, same story. UAE is trying to go a few steps forward. So there are a lot of these regulatory, what do I call it, friendly environment in specific jurisdictions. India is well behind the curve now, partly because of the fear that people are getting too sucked into the hype of crypto, and they're getting misleading messages from media about it being safe and earning 4 times your interest rates in FDs and all that. It's obviously bad advertising, but that's probably might have spooked the government into taking a far more conservative stance than what a Singapore government has taken or a US government has taken. But it's not clear as to what the regulations are going to be. So there is, the best case is cryptocurrencies, what we call cryptocurrencies, become basically crypto assets. They don't have to become anything, they just get called crypto assets, and then SEBI regulates them and puts some control on the exchanges, which by the way do need to be controlled, because today if a crypto exchange goes down, a lot of people will lose a lot of money. So one is basically trusting a lot of money with an unregulated body or entity. So SEBI regulating a crypto exchange isn't the worst idea. And crypto assets getting called cryptocurrencies getting called assets is not the worst idea. It can also generate tax revenue for the government, short-term cap gains below 3 years, long-term cap gains after 3 years. So that's the best case in terms of what we can expect from the winter session.
So it's as for the regulation India is concerned, you're saying it's still ambiguous. Hopefully soon we should get some clarity, because they are talking about regulation in this session of the parliament.
That's what the original plan was. The expectation now is that it will only come out of Lok Sabha, but it will remain still to be discussed in Rajya Sabha. So it's likely to come at the end of the session, not in the middle, as was the original hope.
So why do you think Indians, especially, total percentage is very high number of investors out of India, and why Indians adopt something, something very looking very risky, very scary, or very mystical like crypto in a large number so soon? Is there have you seen something comparable to other countries?
Not exactly. I think the Indian millennials are at the forefront of this adoption. Older investors have been cautious. I have been asked by a lot of my friends, so I'm 41, a lot of my similarly aged friends have either dabbled in it after a lot of research or have stayed away from it completely. Because either you invest serious money or you don't touch it at all. That's most of how people thinking about it. With millennials, the thing is they're anyway investing only 5,000, 10,000 rupees. So they don't mind the fact that in 100 rupees they can buy a very small portion of a Bitcoin and or whatever, a new coin or something. There are thousands of coins now. So you buy some coin and it becomes 10x. So suddenly your 1,000 rupees becomes 10,000 rupees. And what is the worst that can lose is basically your 1,000 rupees becomes 100 rupees. So since they're handling such smaller amounts with the hope that things can become 10x, that's quite heady for many of them. And the way to do that is so simple vis-a-vis conventional stock market investing, which is a lot of demat and broking and login passwords and lots of research required to be done. This seems like a easy fix. So that's bulk of the investors. So all the numbers that get thrown around, I think 95% plus might just be people below 25 years of age.
Basically, youngsters, they want to test something new.
Correct. Each investing less than 10,000 rupees.
So some of the viewers are asking that what is the best way to buy crypto and hold crypto? Because there are various ways. You have probably you can explain how you can buy on the exchange and how you can buy on the wallet.
So that I wouldn't want to specifically advocate one exchange because it gets a little bit complicated legally speaking. I would just highlight which coins are worth buying and then leave it to you to decide whether you want to try WazirX, CoinDCX, Coinbase, or whatever else which is currently available in India. It's a function of whichever of these exchanges allow the specific payment gateways that you have access to. So in terms of coins or cryptocurrencies in particular, this keeps changing every day. It might be even lesser or bigger now. I just took one single snapshot and I'm just presenting that here. So Bitcoin is the biggest, followed by Ethereum, Binance, Tether, Cardano, Polkadot, etc. Each of them have a separate proposition, have a separate technology underlying it. And that's what determines whether it's going to become very big or not. So the core of it essentially is basically the simplest of the technologies is Bitcoin, which simply allows payments. But that's the oldest. So that started in, there is a chart here. So you look at the center of this circle, the Bitcoin is the starting point of everything. And then 3-4 different use cases evolved: smart contracts, settlement, privacy, conventional, and so on. And there are coins which emerge in each of these domains in each of these years. So Ethereum, for example, a big one came about in 2014. Ripple came about in 2012. Tether in 2016, so on and so forth. More recently, Cardano came about in 2017, and Polkadot, which is not even shown here, came out 2019, almost 20 now. So the technology differs, and that's what determines which is a good coin, which is not a good coin. So our choices, basically, we listed out 10 choices. These are not recommendations, so don't think of them as such. Anyway, it's not ideal for an investment advisor of any sort to give recommendations for this. This is more research than anything else. Bitcoin's very big. So it's primitive in terms of technology, but it's very liquid. So there's lots of buying and selling of that happens. Everybody buys that just for that. So that's the basic premise. Ethereum is very versatile, a great platform for smart contracts and all. So, and it's also moderately big. It's not too small. Cardano is a promising technology, and it's what is called a proof of stake. So it is a relatively good choice on that front. Polkadot focuses on multiple chains operating, coexisting together. Avalanche is good for decentralized finance. And if that takes off, then Avalanche will do well. The next set of coins are essentially Binance, which is basically a crypto marketplace globally. Polygon is a homegrown Bangalore-based company used to call Matic earlier. It is a layer 2 solution on top of Ethereum for scalability. Maker is an interesting distributed autonomous organization technology play. Uniswap is a decentralized exchange for transacting in coins with each other without having to pay or go through a centralized exchange. And chain link is for bringing rest of the world's data into blockchain to enable interesting derivative contracts and so on. A quick overview of this essentially just to give you a sense of the fact that it's good to know what is the technology choice you're making to buy a specific coin. And any of them could basically become worthless after 3-5 years, and any of them can become 10x, 50x, 100x also in the next 3 to 5 years. We don't know as of today. Think of this as small cap stock. The risk level is very similar, maybe slightly higher than a small cap stock in the equity markets today. So that's what I would say as recommendation.
So what is the percentage of investment what you would recommend an investor in crypto as a portfolio?
Okay. So normally I personally have, despite being so interested in this domain, not more than 5% of my total portfolio in cryptocurrency. I have seen extremely enthusiastic people still limited to 10%, and anybody who's very new to this space and is just starting to take some exposure, I would say about 1% or 2% at best.
Okay.
Because they're very volatile. So
Very well.
the thing is, you should be able to write off that money. That's the logic. So if you buy a coin and it becomes a third, that shouldn't bother you. Because there is a probability of that happening with even the biggest coins. Smaller coins can become worthless in just a month or less, just as they can become 10x as well. So think of it as very, very high risk, high reward assets. So 1% is pretty much it.
Okay. See, there's one question from here, whether crypto can be is it an investment or it's a speculation? At
the end of the day, all investment is speculation anyway. Right? I mean, if you buy Infosys today, it could actually become, it can keep growing at 10-15% for next 10 years, or India could go through a lot of fluctuation economically, and you might see only 5% or 3% return in the long term. So other than fixed deposits, almost everything has some sort of risk and some sort of reward. So question boils down to what is the risk return and is it worth it? Some things are very risky, like private equity, and the returns aren't commensurate with the returns. Crypto, in my view, is now, especially the large crypto coins, have a very high risk and very high reward. So then they are commensurate with each other, both high. But if you enter crypto with the thought of making 10x in a month, then you are essentially investing in a manner similar to how you would invest in a small cap equity based on rumors. Saying it's a tip from a friend. I'll buy this stock, it will become multi-bagger. I'll watch something on Money Control, I get a 10x idea from there and hope for that to materialize. Same story goes for crypto also. If you do it with that intent, then it is speculation. If you believe blockchain technology is going to do well, which is what I believe. So I've never really sold coin in my life. I just bought. And my bet is basically 5 years to 10 years, really. So the idea is to keep accumulating as prices keep falling and then hold on, never sell. If that's your bet, then it's not a speculation.
Okay, there's one question from the viewer. Typical corporate world we are in. This person must be in the finance department. He says, how can I de-risk the crypto fluctuation like a mechanism you have for forex hedging? Can I hedge a crypto risk?
There are complicated contracts available overseas for hedging crypto, but the point then is why bother buying it, right? It's like saying, unless you're asking for a put contract, right? So even equities, for example, you can today think of it as this: you buy Reliance Industries stock, and now if you hedge it with Reliance Industries future, then you have neither the upside nor the downside from Reliance. So you just basically bought an arbitrage position that will generate for you 3 to 4% a year, maybe 5% a year. then you could have jolly well bought a fixed deposit and Reliance just became a specific name. So fully hedging anywhere is irrelevant. If you're thinking about a put option, like you buy, if you buy, let's say, Nifty ETF and buy a put option at say 13,000, so that if it falls below 13,000, you don't have a loss beyond that. That has some relevance because you don't have a catastrophic loss, but you pay some premium to buy the put option. Unfortunately, the put options for such hedging things on crypto are very rare because most of the buyers buy them for outsized gain and invest very small sums in it. Today, there isn't a crypto hedging liquid enough contract.
Okay. So, since regulations are not clear right now, so people who are buying and holding already, almost they're close to 10 billion invested apparently in India. So, tax implication, it should be shown as a income from other sources if they do a transaction. Is that how it is?
That's what at least most of the chartered accountants are telling their clients. It's like any other short-term trading in non-equity assets. So added to the income, essentially.
Yeah. So one question Mr. Rajaram is asking is, since blockchain helps in creating a ledger, how is the network creating the ledger formed? Who forms? Who owns? Who controls the network? Somebody has.
Interesting. Sorry.
Somebody has to run this, right? So that question is, who actually owns and controls the network?
In the blockchain context, the network is run by its participants. So when I say participants, crypto has distorted things a bit. So that's what we tend to all think of ourselves as crypto users because we buy a cryptocurrency. And there is some vague mention of a network backing all of it. So that's not what the original idea of a decentralized blockchain solution was. So if I were to go back to the original idea, it is this, that all the users are themselves maintainers of the network. So if I'm using Ethereum for any smart contract, or I'm using Bitcoin for payments, or I'm using any other blockchain, I'm also a participant in the network. And what I participate in the network with is computing capacity. So either I have a laptop or a cloud server or some computational machine on which I can run what is called a client. So Ethereum client is available on Ethereum website, Bitcoin client is available on their website. It's generally available in public open source. On GitHub, you'll see every client being available. Whichever you want to do it in Go or JavaScript or Python, it's all there. So you're supposed to download the client on your local machine, like a laptop, run it, and have the network connectivity to be able to talk to the other nodes in the network. It is essentially these nodes that are shown here, which essentially maintain the overall ledger. So each participant in the network has the full ledger. And any addition to the ledger is essentially managed by consensus, which is where cryptography enters the picture. But bottom line is everybody has a full copy and everybody validates everything. Sounds wasteful, and it is. So there are scalability challenges there. But it's robust without any one person having super admin access or anything of that sort. And people are free to join, leave the network if they wish.
Okay. The next question, Mr. Vishwanath is asking, as cryptocurrency is not linked to gold, which is a precious metal mined from the earth, where does it derive the value from? How this price is going up and up when there's nothing underlying?
So there are two sources of value for a cryptocurrency. One source, again, Bitcoin is different from Ethereum in this. Ethereum is different. So Bitcoin is one type, and then the second generation. So there is first generation, which is Bitcoin. Second generation is Ethereum, and third generation is Solana, Cardano, Polkadot, and all that. The reason they're called generations is because Bitcoin couldn't do anything other than record transactions for payments. That's it. Ethereum could enable smart contracts, which is a way superior functionality. And then now Polkadot and all are doing a lot more complex things. So the source of value for Bitcoin is the fact that it will hopefully be accepted as a currency. And if it is, then whosoever holds that currency will have a lot of demand for it. So that is the naive hope of Bitcoin enthusiasts. It is a false hope, and I don't think it's ever going to materialize. Bitcoin may not have much value in 10, 15 years, as people realize that that project is essentially become outdated. I mean, or becomes a hobby project. That's because if it does become big enough, the governments may actually step in and start it's illegal and so forth, and people may just back off from it. So Bitcoin has that basic utility that if their dream comes true, that there is no dollar left in the world and it's basically everybody is paying each other through Bitcoins, then whoso holds a lot of Bitcoins is rich by definition. So that's a pipe dream, really. The realistic value to a currency like Ether, which is used in Ethereum, or Polkadot, which is used in Polkadot, comes from the fact that to use the Ethereum network, you need to pay. So if you want to create a loan transaction in Ethereum network as a smart contract, or you need to issue a token backed by real estate or a non-fungible token or something like that, that transaction requires you to pay for it using Ether. So since you're going to use Ether to pay for transaction, then that becomes valuable based on who all are going to deploy these sort of solutions on Ethereum. And since that is growing by the day, even if you hold Ethereum and you don't actually deploy anything on Ethereum, you can at least be sure of the fact that yes, everybody who's deploying these solutions is going to ask for more Ether, and hence the value of my holding will go up. So it's technology backed. That's how Ether derives its value, and so does Polkadot and so on. The reverse also holds true. If the technology fails and it or doesn't take off, people don't adopt to that specific proposal of whichever currency that is, then your value may not go up a whole lot. So it's not all that different from startup investing versus mid-cap investing versus large-cap investing.
Okay. So the other question is, you're saying that the crypto, any crypto is finite, right? It has a specific number. So more and more cryptos are coming, right? So every crypto is finite in nature. This is a question been asked by Balasubramanian.
Most cryptos are, because nobody wants to sign up, or not too many people are super excited about signing up to buy the early units of a crypto token if the supply is going to be unknown. So it's almost like being told that you buy these today, and today there are 1 million tokens, but tomorrow there could be 1 billion. And so the value of every token is suddenly one, like the Zimbabwe hyperinflation scenario. So since it is so etched in people's collective memory, and the whole DNA of the crypto system is to keep the supply finite, almost nobody has experimented with unlimited supply or unspecified upper limit. Some keep a backdoor open saying we will potentially, if everybody agrees, we can increase the supply, but otherwise most chains or most cryptocurrencies specify that they will be capped here or here or here, wherever that number is.
Okay. Next question is from Raghavan. Is how are you saying that Bitcoins are protected against hacking? It cannot be.
So let me put it this way: there are attacks and there are hacks. There are two different things. A hack is if you want to burgle someone's wallet to take their Bitcoins away, right? That's what I would call a hack. That is possible if you can dupe the person into giving you his or her private key. It's as simple as that. It's like giving a password to internet banking. So if you give that away, then yes, that is hacking. So that can be done through social hacking. So it doesn't have to be. So that's a very conventional sort of hacking. Can a very savvy techno hacker alter the entries in the ledger so that his or her name or address, wallet address, shows suddenly a very high balance and everybody else's shows low or leaves it alone? Answer to that question is it's extremely unlikely. So that's the whole power of blockchain network, that just technologically hacking without stealing passwords and all, just simply saying I'll show up in some sort of super cool sci-fi level coding and then hack it. That's not possible for a simple reason that unlike hacking a bank database where you just need to go through some firewall and know the right backdoors and so on, once you're through all of that, you open into the walled garden of the bank and its database. Once you're in there, you can change anything. So that's the conventional hacking of a centralized database. In Bitcoin or Ethereum or any other chain, blockchain-based crypto asset, you can hack 1, 2, 5, 10 nodes, but the copy of the ledger is maintained on 1,000 nodes. So you'll have to hack 1,000 nodes and change their thing as they keep adding new blocks. And the cryptographic linkage to the previous block means that you can't hack one block in isolation. You have to hack it in 100 or 1,000 places at the same time just to change that one entry, whatever that one entry might be. So that's why the probability of that being hacked is extremely unusually low.
Okay. So eventually, is the crypto going to disrupt traditional investment like gold and stocks, or will it remain like a current 2 trillion? It can go up to 20 trillion, but will it be will it remain at a small percentage of the overall traditional investment?
So there are two questions to answer here, right? One question is cryptocurrency as they currently stand. Bitcoin or Ethereum or Cardano or Solana and so on. Will they become from the $1 trillion to 10, 100, whatever? And second question to ask is, will blockchain technology disrupt the very fabric of financial services industry, the way we organize our capital markets, the way we organize our funds, lending, borrowing, insurance, payments? Answer to the former is that think of technology sector back in 2001 or 1999, 2000. A lot of hype, a lot of dot-com boom and so on and so forth. And obviously it went up, then crashed. A lot of people lost a lot of money. But after all the things settled, we had a lot of high quality businesses out there, such as IBM, Microsoft, Google eventually, and so on and so forth. Right? Amazon, which emerged out of all that innovation. Out of the present crypto up and down hype and disappointment cycle, a few winners will emerge, which will be long-term technological innovation, and they could become 1,000 baggers over 10 years. And then hence we have to see this whole thing as market capitalization of all cryptocurrencies put together. I would say to the extent that they represent technology, so excluding Bitcoin and innovations in technology, it does have the potential to become 10x, 20x, 50x, 100x, similar to how Amazon and Microsoft became 10x or 50x or 100x in between 1996 to 2006, just taking an example of a decade. Obviously, just as these winners like Microsoft and Amazon, there were lots of companies whose names we don't even know right now, and some like Yahoo whose names we do know and we just lost track. There are going to be a lot of bad coins also. So the 1 trillion today has some 15, 20 coins making up 90% of it, and a different maybe 5,000 making up 1%. What is the constitution of the $10 trillion after 10 years? It's hard to say. My own specific expectation is Bitcoin will be a very small portion, and smart contract-based chains might be a sufficiently large portion, and some as yet unknown and not launched, like Google turned out to be eventually, will be a very large proportion of it. Who knows? So that's the short answer.
Okay. So how can corporates integrate blockchain technology into their own business transactions, especially smart contracts and all you are talking about? What do you see the future there?
So that's the part which is where, just like Microsoft and Google picked up in value and became big as stocks themselves, but they also brought about technology which changed how banks did their business or how supply chains were organized and so on. We expect that blockchain will change the way business is done, especially in financial services, where I've shown here one slide where talking about how we go to markets today through either markets, stock markets, or through funds. We expect a decentralized architecture where businesses directly raise money from individuals through crypto offerings, and individuals transact among themselves directly without there being a centralized stock market. It's one possibility. Secondly, you can think of lending, where instead of you going to a bank as a depositor and banks giving loan to businesses and individuals, we expect distributed organizations of owned by depositors and lenders, borrowers jointly, like a cooperative, but without having to have this corrupt management running it. Set of algorithms running the distributed organization using some well-defined rules. That's the future of banking in a crypto savvy or blockchain savvy world. And all the loans are basically not only legal contracts, but are smart contracts sitting on the blockchain. And that's what even Neural's aim is eventually to bring about. To take another example, payments. When you, for example, currently route any payment, it is done through central bank or NCPI. Without having to use Bitcoin or Ethereum, we can even transfer simple rupee if it is tokenized through central bank digital currency. You can just use blockchain for a direct peer-to-peer transfer without having to go through any API. Likewise, insurance. We give money to an LIC or ICICI Prudential, and they invest in bond market and stock markets and settle our claims as events happen. This pool can be managed professionally, but the pool can be owned by all the premium payers. And claims can be settled by agencies which actually verify the claims, but otherwise don't do any centralized management of it. So that can bring down our insurance premiums for everything almost 50%, because you don't have to support this big insurance company and its costs and its profits, and you pool your premium and you get paid out of it basically. And then that can be built over millions of people, not just hundreds, as you become comfortable with the thought that the underlying blockchain technology will enable trustless handling of this transaction. So these are some of the examples. There are many more, but I'll just sort of be endless presentation otherwise.
Okay, there's another question, Swapnil, from Mr. Joshi. Is there any mechanism for Income Tax Department of India to verify the profits on cryptocurrency declared by investor through an independent source? Right?
Today, no, not so much. In fact, that's one of the things we're looking to solve in our blockchain as well, which is today my wallet, which I've created on a exchange or whatever else, is not linked to my KYC. So I can transact in Bitcoin, Ethereum, in whatever else without having to submit my KYC to anyone, which is a problem. So if tomorrow I could create a wallet only, so on Neural we enforce that. So you can't create a wallet unless your KYC is known to the chain. So KYC is not disclosed to the public, but your hash of your cryptographic hash of your PAN number is there. So you can't fake it. So that's how the Income Tax Department of tomorrow can verify that if I want to check XYZ person whose PAN number I know, the hash of that PAN number also I can create locally. That hash I'll match with the hash stored on chain and check out all the transactions carried out by this person, buy and sell. And then I can get the capital gain statement through a very simple local application. But today it's not possible.
See, one of the things which is rumored in the newspapers that the government may say that you can buy only through the exchanges, and these exchanges are regulated by SEBI. So, and any transaction, it is illegal to buy on your private wallet, and you buy only through exchanges, and exchanges are regulated by SEBI. So, SEBI can ask for entire data of all transactions. That way, again, government gets hold of entire data, right? Is that a possibility?
That is a possibility with a lot of loopholes. I'll tell you what, because today, if I were to hide my purchase of a stock, I can't do so even through an off-market transaction. So exchange is one thing, but off-market transactions are always allowed. But since the data is maintained with NSDL, I can't hide behind an off-market transaction in case of stocks and bonds, demat stocks and bonds. But with crypto, I can have my friend do the transaction on the exchange for the primary purchase, and the friend can then transfer the tokens to me through an off-exchange transaction, which is not disallowed in Ethereum and any other big chain. And then I sell it in peer-to-peer context to someone else without there being any trace from the exchange for that. So the simple control of exchange is not enough if you want to make it traceable. It will have to be at the chain protocol level that the KYC is enforced. That solution currently doesn't exist in the major blockchains. One of the solutions we're working on is exactly that. KYC at protocol layer is the only way to have zero loophole tracking of transactions. Okay.
So basically, there could be a possibility of even exchanges exchanges are not protected from this hacking, right? So that they can, there are a lot of run on exchanges across the globe. So it can happen in India also.
So there is a risk people ignore when investing in cryptocurrencies. I want to highlight that. When you buy cryptocurrency from an exchange, if you don't transfer it into your wallet, think of it as a transaction where you gave money to a broker in equity market, and the broker bought stock for you and said, yes, I am holding this stock in your name, but didn't transfer it to your demat account at the end of the day. Now, if this broker goes bankrupt, you will lose your stock because the broker had a liability towards you to pay that stock, but the broker itself is bankrupt, so you can't sue them, or anyway, the stock is gone. So that problem persists in today's crypto exchanges. So if you go to any of the crypto exchanges in the country, they don't automatically transfer it to your wallet. They simply say, we have a central ledger, which is funny because crypto is supposed to be decentralized. But the exchange maintains a ledger saying, if Swapnil buys half of Ethereum and 2 of Avalanche, I'll say, in my ledger, I'll put it against his name, but I'm not transferring it to his wallet. So the exchange goes down, all my money is lost.
So that's the big risk.
So whenever I buy something, I always transfer it to my own wallet from the exchange wallet. It's like saying from my exchange broker demat, I move it to my demat. That they allow, but don't do it automatically.
Okay. So how another question that how to hold in wallets? Exchanges, I think you're it's simply logging into the exchanges what are available in India. So the private wallets are held outside India, right? So how to hold it in the wallet?
Well, technically a wallet is simply a key pair, public key, private key pair. So you can't exactly say it's held outside India because the data is on a distributed ledger. So it's probably at 3,000 servers in the world at the same time. It has no geography as such. The very fact that it is distributed means it's in maybe 50 countries in the world at the same time in 1,000 different computers. So the wallet provider's company might be in US or UK, but the specific wallet data that you have is in a distributed fashion. India, and so some of the nodes are in India as well. So to that extent, maybe 1/100th of your data is 100 of the 100 copies, 2 out of the 100 might be in India. So long as the government doesn't explicitly say that all the wallet providers also have to be India based or they have to have the data in India, currently at least it's legitimate and legal to hold in a wallet like Coinbase, for example.
Okay. Another question from Pramod Kumar. If I have one Ethereum, does it mean that I am one of the participants? I am also one of those nodes, and who holds the ledger?
Okay. You're not a node if you hold an Ether. You simply have bought it in a peer-to-peer purchase. To become a node is another actual exercise of buying the hardware, installing the Ethereum client, and connecting to the node. There is nothing required in the form of any permission to join the Ethereum network. You just need to invest in the hardware, and the software is free anyway. The hardware is what might cost a little bit because there is no point in becoming node if you don't want to mine it. If you want to mine, then you need to compete with other miners who have heavy duty hardware. But leaving that aside, to become a node, you just need, technically, you just need a laptop to participate in the network. You won't get anything out of it because the competition is intense. But you can become a node just by having a laptop and downloading the free client from the web. By virtue of having an Ethereum, you are an entry in the ledger that this is the address which corresponds to your private key. And it has 3 or 10 or whatever number of Ethers. Each address is not a node. So the nodes are just in thousands. Addresses are in millions.
Okay. So Venkatesh is asking another question. Do you see in the future a cryptocurrency replacing normal currency? If it is yes, how it is going to affect the transactions?
So as I mentioned earlier also in one of the answers, the big crypto dream of Bitcoiners is the pipe dream. I don't think that's going to materialize. In any case, even if it materialized today, it would be disastrous because to buy a coffee, then you'll have to pay $5, $2 for the coffee and $5 for the transaction. So your coffee would cost $7. Although the store will get only $2. The $5 will go to the network. So anyway, it's pointless. There are solutions people are talking about to make it low cost and all that, but it's not cheaper than Visa and MasterCard. So you're not going to be able to swipe for 100 rupees and the merchant is happy with the 2 rupees that it costs to pay onward, and Visa and bank and everybody else is happy with the transaction, paying them only 2 rupees. That's not going to materialize in any form, at least in foreseeable future, in any of the current offers. That's the technological limitation. There is also the legal limitation that legal tender is the job of the government to specify. So if the government specifies that it's not legal tender, so El Salvador has said that Bitcoin is legal tender, which is fine. That's their choice. But at least it's legal in El Salvador to pay each other using Bitcoin. In India, it's not a legal tender. In US, UK, and the most progressive of them, Singapore, it's not a legal tender. So if you were to say informally, I want to pay each other to settle my dues to each other through stable coins, that is fine, informally speaking. But can a company pay its employees in stable coins unless it's accepted as a legal tender? I think it's quite a gray area. Will companies move to paying each other for their services and goods based on other cryptocurrencies or stable coins? Again, a gray area. So conventional cryptocurrencies, the sort that you see going up and down in price, it's virtually impossible to imagine them as genuine replacement of the fiat currencies. Central bank digital currency is a different matter. But from a price speculation perspective, it's pointless because that's stable coin. It's not going to ever go up in price. It will be exactly $1 for one coin or 1 rupee for one coin. So it's a technological innovation with no price implication. So the ones which do have a price implication, they are not going to become currencies like ever.
Okay. So basically, for a small transaction, it is not feasible and economical, right?
That's correct.
Unless it's a large transaction, right? The another question related to that. Now, government is saying they will bring their own crypto, right? And it is, I don't know whether it's a crypto or it's going to be digital currency. So how does it going to compete or survive, coexist together?
So there are two modes of creating a digital asset. What is called, so let me just try to share a presentation. What's called native issuance and what is called on custody. So today also, you already have currencies like USD coin or USD tether, which are essentially simply dollars in crypto form. That's all. They don't do anything else. So these already exist. So that becoming that's what is called essentially a crypto custody-based tokenization. I just was trying to find this. Okay. So this is the tokenization through custody logic, where somebody holding dollar issues some tokens backed by them, and the investor owns these tokens, and that fact is recorded on blockchain, and this recorded asset holding is also recorded on blockchain. This is what USD coin today is. Tether coin is also this. So they all have dollar equal to 1, as in the value of USDT is $1 forever. The value of USDT is $1 forever. So that's tokenization through custody. That already exists. And tokenized through native issuance is, you can do it for unlisted shares and bonds, but you can also do it for central bank digital currency. So if a central bank were to say that I will create a blockchain token, either on an existing chain or a private chain of its own, and on that, those tokens will represent rupees or dollars or whatever that might be, and it's backed by central bank. The issuance contract, like a note, currency note, it is a token, and there is a finite supply of it, and the government is liable to pay that amount if somebody presents it. So that becomes a CBDC effectively, so central bank digital currency.
Okay. There's another question Mr. Jagdish Rao is asking. Crypto being highly volatile, is there a way the price movement can be regulated by the regulator?
So that I see as an extremely unlikely scenario, because regulators either ban it or say that. So circuit breakers I don't see happening in crypto markets for foreseeable future, although they are there in the equity market. It would be, I guess, a regulatory challenge also to enforce it. So I don't expect that to become a mainstream.
So Mohan Sundaram is asking another question. Considering that Bitcoin is not backed by any tangible assets, isn't it a distinct possibility that it can become worthless as well? Total downside risk.
Absolutely. In fact, I'm claiming that most likely Bitcoin will become worthless in the next 5 to 10 years. The point boils down to think of it as a payment solution which eventually didn't take off. So then that's why Bitcoin has very limited future. But other coins aren't backed by just a payment adoption of their platform for payment. So Ethereum claims to be a smart contract repository, and there are people already using those smart contracts for a lot of interesting things. Now, if those use cases pick up, then Ethereum's value will stay. So then Ethereum is more like a company stock than a currency. Now, in that form, the company stock has value because the underlying company is providing some service. If the service is valuable, it will probably pick up in stock price. If it doesn't, it doesn't. So beyond Bitcoin, the other platforms have specific use cases and services that they provide. If the services pick up, then yes, you would actually have those prices hold up. They don't pick up either because of regulatory concerns or because of lack of adoption. They will become worthless. So that's not because no inherent value logic is only for Bitcoin, not for other currencies.
Okay. The next question is on NFTs, these non-fungible tokens. What are these NFTs, and how would such assets are actually can be regulated?
So NFT is an interesting use case of cryptographic techniques and blockchain for non-native assets, as we call it. So when I say native, it's, as I gave the example earlier also, rupee is native to India. It has no value outside India. Likewise, Ether is native to Ethereum. Once you leave Ethereum, it has no real value. As in, it has value in investment sense, but not as a payment mechanism. So I guess that's what we're referring to here as well, that NFTs are representations of real world assets. They are not native. So the real world asset in its simplest form could be something like a painting or a song. A more complex version of NFT could be a property. So we say this is a commercial property. It has tenants, it has owners and all that. I make an NFT of it by mapping the ownership to that NFT and say now the whoever owns the NFT will own the underlying asset. So there's a lot of legal challenge in it, and that's what one of the things we're looking to solve in Neural is this legal linkage of a real world asset with an on-chain token in a legally enforceable way. So the property is an example. You can do it for brands, you can do it for patents, you can do it for a movie, anything which has some economic interest.
So how does this asset tokenization you've been talking about? So it is similar to the property what you were saying, right?
Right.
So hold the asset and tokenize it.
Correct.
The other thing you had mentioned in one of your articles that people can tokenize the large government bonds.
That's true.
How does that work?
So we tried one version of it. So I'll just walk through that logic here. Yeah, so this is how we actually tokenize the government bond on Neural. So we bought the bond from the market. We did a legal transaction, legal documentation of transfer of beneficial interest to the owners of tokens newly created on our blockchain. So there is an actual agreement we executed. The agreement mentioned the chain, specifically the chain with its identifier and the token that is issued on it. And the chain mentioned the agreement through this legal document hash, which is unique to this document. So this two-way linkage made sure that the tokens are enforceable in the court of law if the need arises. And these tokens are then sold to investors for one token for about 100 to 110 rupees based on the accrued interest and all. And we had some specific ways to buy it. So this was one example of tokenizing an asset. And then interest which comes to the underlying bond, the person holding the bond, which is in this case a new tokenization trust we created, it pays it onwards to the holders of the token.
Good. So the next question from Jagadish is that Government of India has been talking about regulating crypto transactions. There are even confirmed reports, income tax notices being sent to persons dealing with crypto. Is it safe to get into dealing with crypto and still be in compliance with the regulation?
If you haven't done it so far, I would say wait for 6 months because it's not like the prices are going anywhere. In fact, they've fallen in the last couple of months. And if you want to make a long-term bet on crypto, whether you get it in 1x or 1.5x or 2x doesn't matter because it potentially could become 10x. So it's okay if you get it slightly late. On the other hand, if it does come through, the regulations are clear enough, then you would be safe in working in a regulated environment. The exchanges will be more accountable. And there will be no hassle of having to transfer money through very convoluted routes. Currently, you can't transfer from bank to a crypto exchange because RBI is averse to it, even though the Supreme Court has confirmed that it's legal. So Parliament will have to finally say yes or no and regulate it. So we give it 3-4 months, maybe 6 months at most. You'll have at least clarity that you can't do it, or you can do it through these mechanisms.
Good. I think I have covered most of the questions. There are questions on hacking, which you have already answered. And Prajakta is asking, can you suggest some more reading material on this and impact of blockchain on financial world?
There are a couple of, there is a interesting paper written by OECD, the Organization of Economic Cooperation and Development, on asset tokenization. So I'll email that paper across to Dr. Om Prakash, and he can then circulate amongst the participants. And there are a couple of other good, interesting use cases for blockchain beyond currency in real world. So I'll send those papers also. So those could be interesting.
Sure, Swapnil.
So the next one is how the blockchain will impact the banking processes.
So there are two ways in which it could. One is inside the banks, and second is replacing the banks. So inside a bank is already starting to happen. I've heard recently State Bank, Federal Bank, and one more bank used for remittances and some interbank settlements, open source blockchain of Hyperledger or R3 Corda. So nothing to do with cryptocurrencies, just blockchain. So these sort of consortiums are already starting to use blockchain. Even in US, there is a good consortium of JP Morgan, Goldman Sachs, and all. So trying to use blockchain for interbank settlement, instantaneous and zero risk and immutable without disputes and all. Remittance is also starting to happen. So Ripple is an interesting cryptocurrency, but otherwise it's aimed at replacing the SWIFT system globally for international transfers in a compliant manner. That's a within banking variation. The replacement of banking is a sort that I mentioned some time back, where if you can disintermediate bank by essentially either dealing with lenders borrowers directly as a depositor, or savers directly if you're a borrower, and gradually those collections of people evolving into decentralized banks, micro banks, or nano banks, who aren't governed by any board or CEO and management and all, but are governed by specific well-defined rules and a decentralized autonomous organization. So both those trends are currently in play. The former is already happening, which is banks using blockchain for efficiency improvement. That's very similar to them using internet. So that's fine. The more revolutionary one is decentralized banking, where banks won't exist, maybe 20, 30 years down the line, or they'll look very different from what they do today.
Another question is that, these cryptos are finite, right? Each one has specific number, but more and more new cryptos are coming, right? So that way, number of cryptocurrencies today already about 1,000. It can be some 10,000 at some point of time, right?
Yep.
Can it be really called finite?
Yeah. So that use case to me is with no real future. So the Bitcoin sort of use case that derives its value on account of being finite is the dying solution. Most cryptocurrencies today, I think of them as stocks. And since there are 1,000 stocks in India, maybe 10,000 stocks in US, and maybe 50,000 stocks in the world, doing different things for different sort of customer segments and geographies, we expect crypto assets of the future doing specific things for specific types of use cases and living and dying by it.
Okay.
No real payment use case is going to exist where cryptocurrency replaces a fiat currency and hence it being finite has value. I wouldn't really go into that at all. I would simply say, look at a cryptocurrency like a stock and say, is this doing any real service to any real use case? Even if it's a native crypto use case, like lending, borrowing, whatever it might be, or smart contracts, so on? Or is it simply a payment solution like Bitcoin? If it's payment solution, then finitude is important. And since there is, for every Bitcoin, there is a Litecoin and Dogecoin and lots of other similar looking solutions, you can't control the supply by just virtue of being saying this is 21 million, but another coin can be a copy of it and it can be 50 million. So the finitude has no real meaning.
Okay, another question from Rajaram. Can you illustrate mining of cryptos? How is value determined?
Value is not determined in mining. Mining gets you free cryptos basically. So if you're a miner of a Bitcoin operation, what it does is essentially the point I mentioned about putting transactions in blocks, which was, I think, here. So I'll show you this illustration. In fact, it's actually a good illustration. So this is the block. So when I'm mining, what I'm doing essentially is, this is the block number 4500 to 3. Ignore this number for now, let's call it 0. And I have some data saying transaction 1, transaction 2, transaction 3. As a miner, I take these transactions from what is called a memory pool and look at this hash. So this hash, I don't control this. This combination of the block number, nonce, and data and the previous block hash will give me the current block hash. So as a miner, what I need to do when I click on this is carry out the transactions, the calculations in the background, which anyway the computer does, which leads to a hash with 5 leading zeros by altering this one number. Because this I can't change, the real transaction. This number is a fact. So the nonce is a random number. So this number I keep incrementing till I get this hash. And whosoever solves it gets the free Bitcoin or free Ether or whatever for that specific block. So each block has a reward, and then the one person creating the block gets the reward. So yeah, that's how mining works.
The mining is earlier significant used to be in China, so it has now moved out of China, or it is Chinese companies have moved to other locations.
Well, there is mining. So there is a bit of a distortion brought about over the last 10 years. When Bitcoin first started as an interesting hobby project, people didn't need anything more than a laptop to mine. It was easy because everybody else had a laptop, but like a game theory thing, right? They started competing for the next block. Once it became valuable, then people who were rich essentially bought very heavy-duty computer systems and said, okay, then they started getting ahead of the competition by being able to mine faster. Now that led to an arms race of sorts, and people went to the extent of actually going to specific chip design at a Intel or AMD level, which are specializing in cryptographic calculations. So it went to that extreme, which is no real societal value. Some people also took up mining rigs in Mongolia because the climate there is cold, so you don't have to spend that much energy in cooling systems and so on. So all of this wasteful expenditure. And China, because the coal-fired power plants created a fairly cheap source of electricity. That's the only thing you need to spend once you buy the equipment. So that's what led the government of China to crack down on it, because that power is utterly wasteful. So a lot of people say that Bitcoin network today spends as much power as the whole country of Denmark in a year. So, and that produces nothing really valuable. And there are alternative algorithms and consensus mechanisms which don't require that much power. They require a power 1,000,000 times lesser than this proof of work. So as things stand today, it makes sense to use proof of stake without compromising security and decentralization, without using this sort of mining mechanisms that are currently China-centric and also getting driven out of China. and it will get even driven out of every other country also gradually.
Okay, then another question is, can crypto be held as long as a long-term investment or only used as a trading opportunity?
I would say there is no trading opportunity there. It's as much as an opportunity as you would think of a random mid-cap or small-cap stock. Why would you buy and sell a small-cap stock on rumor just because it's going up? You probably could be the person who everybody else is counting on to hold the baby when everybody else is run away with their money. So just as you wouldn't recommend trading in small-cap stocks, I wouldn't recommend trading in crypto. Buy it if you understand the technology or are excited about it, and hold it for 3-5 years and accumulate with every small dip in the price. Otherwise, not much is to be gained from trading in crypto.
You're saying look at the underlying technology, right? Predominantly.
Right.
Good. One last question. With so many cryptos, there is any chance of some of the currencies becoming illiquid or illegal in the medium term, and how do we protect against such eventuality?
So there are specific problems with specific currencies in specific jurisdictions, but the idea would be if you stick to the top 10, they are either all going to be legal or all going to be illegal. There is amongst the top 10, 20 biggest cryptocurrencies, there is nothing that suggests that Ether will be legal but Cardano won't be. There could be fraud. That is quite possible. That one of the major currencies turns out to be governed by a bunch of crooks and turn out to be fraudulent. That can happen. But that's like Satyam went down, right? It was a big large cap, but still was fraudulent. So that exists as a risk. But outside of that, I don't expect the top 10 cryptocurrencies to become suddenly illiquid and suddenly illegal. One of them suddenly illegal. All of them can become illegal in a jurisdiction which doesn't like them, like India. But it will not be 1-0. As in, it will not be one at a time. It will be all or none.
Okay. Venkatakrishnan has one question. If Indian government wants to introduce crypto and blockchain in a coordinated manner, give us some example of commercial transaction where these can be introduced. Ideally, we would like to see through banking channels.
So my favorite use case is remittances. So currently, if US-based NRI has to send money to his father or mother in India or her father and mother in India, they have to pay anywhere between 2 to 5% to send the dollar. That takes 3 days to come to the Indian account. If you put dollar into tokens, rupees into tokens, either same blockchain or different blockchain, doesn't matter. One of the solutions we're developing is in fact that. So in our case, we're developing both of them on the same chain, right? So the NRI can actually tokenize dollars at her end, and exchange the dollar tokens for rupee tokens instantaneously, send the rupee tokens to the parent in India. The parent in India can detokenize the rupees into fiat rupee same day. So the whole transaction can happen within a couple of hours at most, maybe lesser, and can cost as less as 0.25, 0.3% of value as against the 4% that it takes currently. So it's a very concrete use case which is made feasible by blockchain technology.
Good. I think you have covered extensively, and almost all the questions are answered. Om Prakash, I think I'm done with all the questions, and if you have any other questions, probably we can take it. You are muted.
You're on mute.
You're on mute still.
Thanks, Jay. Thanks for taking the whole session by moderating and reading out all the questions. There are some few questions which I would pose to the speaker. One is, coming from the legal point of view, where do you place this? This is a cyber crime or an economic offense or a penal offense? How do you position this? Who is responsible for that? Will the police be taking cognizance of this? Where do I file a complaint? Who's the authority?
So as of today, it will be in the intersection of cybercrime and economic offense. If an exchange were to run away with your money, but the sheer fact of owning cryptocurrencies is legal as per Supreme Court today. If Parliament passes a law and says it's illegal, that's different. But as things stand today, owning, buying, and selling cryptocurrencies is not illegal in India as per the Supreme Court judgment. The frauds frauds suffered in the transactions involving crypto will probably be in the intersection of economic offenses and cyber.
So you would like to conclude that it could be a cyber crime, and the punishments could be as per the penal code.
If I'm talking about not holding and buying and selling crypto, I'm only talking about actual frauds committed in the crypto domain. Let's say somebody sells a bad NFT to someone or doesn't obey, or some exchange runs away with people's tokens and all. That's what I'm referring to. I'm not suggesting that holding, buying, and selling cryptocurrencies is illegal. It is not, as things stand today.
Okay. And can you give an analogy, like in a share or a stockbroking, we have the SEBI, we have the stock exchange, we have the investors, we have the brokers, we have the issue house. Can you give an analysis for this blockchain technology as to who is going to be the regulatory authority here?
So the closest candidate is SEBI, and the closest regulations are, there is blockchain technology, there are cryptocurrencies, and then there is trading of cryptocurrencies. There are three different things. So blockchain technology can exist without cryptocurrency. Cryptocurrencies can exist and not be traded, and there could be an exchange for cryptocurrencies like there is exchange for stocks. So in a similar manner as stocks could be unlisted or traded very thinly and outside the exchange, so there could be cryptocurrencies which are covered as crypto assets and not trading on an exchange. That can be a non-SEBI matter. SEBI can essentially cover the part of it where exchanges are involved, retail monies are involved, and people are buying and selling this for capital gain with as a passive investor. And blockchain can be left out of all of this and say that if you're tokenizing a real world asset and handling that in a small group of investors, obeying private placement rules and all that, then that is like a unlisted angel investing sort of behavior.
If I have to convince my wife, what do I say, Swapnil?
Just tell her that what if you could buy Google in 1999?
Okay.
Other question, Swapnil, that there is a fear that the crypto could be used for terrorism and ransom and all that. But the way you are explaining, everything is transparent at the blockchain level, right?
Not the name of the people, not the addresses of the people. That's how people used it for ransom. So the WannaCry virus, which is the ransomware, you had to pay by Bitcoin, and they explicitly told you the Bitcoin address to send the Bitcoin to, the ransom amount. So it was like giving a bank account number. But if you give somebody a bank account number to pay ransom to, the government the police can trace the owner of the bank account, because bank accounts cannot be opened without KYC. So that's the sort of discipline that needs to exist in the crypto world for it not to be used for ransom and terrorism and illegal activities. So it's become like cash. So just as cash, 95% of cash is used maybe for good things, or regular things, 5%, 10%, 20%, some number is used for illegal things. Cash itself is not bad, but it's untraceable, so people use it for illegal things. Likewise, crypto is untraceable flexible. So good 3 to 5% of it is indeed used for illegal activity. And one of our endeavors in Neural is to make crypto wallet KYC at a chain level, not at application level, that nobody can. So then in our version of the world, Neural wallet, giving your wallet for taking a ransom or illegal payment would be like giving a bank account to take a bribe, which obviously nobody will do.
Okay.
Thanks, Jay, and I think it's time to conclude. I will move ahead for vote of thanks. Rupa, do we do the procedures?
Sir, yes, sir.
Yeah.
Thank you, sir. Thank you once again. And we thank all the speakers. Sir, can we conclude or do you want to?
No, I think it's already 6 and I think we are
okay.
Good to close the whole thing. I will, once you show the presentations and other things, I will conclude the meeting by vote of thanks.
Yes, sir. Yes, sir. Thank you. We express our sincere thanks once again for the speakers for accepting our invitation to address on this important subject. As a token of our appreciation, we would like to play a small thanking video. Please do stay with us, sir.
Sure.
Thank you, Rupa. Thank you. Many attendees have asked whether I can share your credentials, the numbers and email ID. So I can share, right, Swapni?
Yeah, not a problem.
Okay. And would you be privileged to get any PPT or any note on this so that I can circulate to the members as a takeaway?
Yes, certainly. I'll email that to you. You can include it in this.
Thank you. Thank you for obliging our request. And let me present the vote of thanks. And I would first of all thank all the members and the attendees who have taken away time to attend this webinar on cryptocurrency and blockchain. And first of all, I would thank Dr. Ravindran who had introduced a personality like Swapnil, and thank you, Jay, for sponsoring this event and also running through the session very lively as an interactive and questionnaire mode. It was very good and it was not monotonous and it was a good breaking. And so thank you, Swapnil, for alternating your talk by presenting at appropriate time the PPTs, and it was not monotonous. One thing which we recognized in today's webinar. And thank you all of you for attending this wonderful session. And we would get the feedback from the attendees and we will pass it on to both of you, Jay and Swapnil, so that we can improvise, or we can, again, if there is a demand, we can reassemble for a series of this, because this is still a very new concept. And what I would feel is, if I don't like chemistry, I will not read that book. That's it, simple. Otherwise, you read, practice, and then experiment the whole thing. Many of them are still, those who have attended, I think, at least have a fair knowledge of cryptocurrency. And I saw a number of questions coming up. So still, India is not geared up. India has 3 tiers of citizen. I don't know how this will get through in the tier 2 and tier 3. This is something, a question which will come up, and it's going to take another a decade's time, I can say. Tomorrow, this can be a currency well talked about and understandable. Today, even in rural areas, Google Pay and Phone Pay is working. So 2 years back, it was not there. Everybody has a bank account. Similarly, this will evolve. Only thing is the legal framework has to be tightened, and people should get the confidence. I think that is where is lacking. Technical people are more onto it and hands on it. People like us are really lacking there, and I think we should try to gear up the whole thing. Thank you very much. Thank you for the wonderful session. Thank you, BCIC Secretariat. Thanks, everybody. So let's close up, and the meeting stands adjourned.
Thanks very much. Good to talk to you.
Thank you. Thank you.